New reporting that China is accelerating efforts to boost domestic AI chips, even as the president is easing Nvidia export restrictions. In today's Tech Check, Deirdre Bosa digs into what more Nvidia chips could mean for China's tech giants. Morning, Dee.
Hey, morning, Carl. So DeepSeek, yes, it's reportedly training on smuggled Blackwells. Meanwhile, ByteDance and Alibaba, Reuters says, immediately asked for H200 orders as soon as Trump reopened the window. Now, this all exposes how far behind China's domestic chip sector still is. It also forces Beijing into a three-way trade-off that it can't win. Letting companies buy Nvidia chips, that hurts momentum behind Beijing's domestic chip champions that, by the way, are now worth nearly $300 billion in market cap. On the other hand, blocking them slows its own tech giants and weakens China's best AI models. Third option, looking the other way, while companies keep using gray market chips, that means giving up regulatory control altogether. So whichever way it turns, Beijing loses leverage. Now, the policy itself, it doesn't supercharge China's AI sector. It formalizes the dependence that already existed in the shadows, dependence that DeepSeek and others have already been exploiting. And instead of breaking from U.S. hardware, Chinese AI labs, they end up even more tied to NVIDIA's roadmap, stuck at whatever generation Washington is allowing. Now, TrendForce, an industry research firm cited by analysts, it predicted that China's high-end chip market would grow by over 60% next year, reaching about 50% market share. But that projection was built during a ban on U.S. chips. This reopening, that could change the equation and threatens all of that artificial demand that Beijing has spent years propping up. That's why, guys, this is not the strategic loss that some critics and China hawks, lawmakers, that they claim. Legal access doesn't actually narrow the gap. It just narrows China's options, and it keeps the ceiling on progress in U.S. hands, guys.
Yeah, I mean, so many questions. There's the geopolitical question, and then, Deirdre, there's the technology question, which you have. And that sort of lends credence to the idea, we were talking to Jack Kittery last hour about, we'll let them build off the U.S. stack so that we can kind of know what's going on there and be more in control. And then they won't do it themselves, and it'll be more of a black box.
And that's key, right? It's all about control, because we know that they were going to do it anyways. Even the first DeepSeek model that made all those headlines at the beginning of this year, you know, there's a lot of speculation that they were able to smuggle a bunch of NVIDIA chips to get there. So what this does is just kind of put Beijing in a real bind. Everywhere they turn, they're kind of losing. And remember, too, that for years they've been trying to build up their domestic chip makers that are far from the technology capable of the U.S. chip makers. So this really forces Beijing into a corner. The chip makers were going to do this regardless. Now it forces Beijing to choose who can and who isn't able to use these NVIDIA chips. And he uses the domestic accelerators, which, you know, end of the day, nobody actually wants to use. That puts this very clearly in focus.
Announcements that Nvidia would be allowed to sell cutting-edge processors to China and that it is creating location verification technology to stop chip smuggling have caused its shares to jump 3.0% over the last week. Over the past 6 months, Nvidia's stock has increased by 29.7%, easily outpacing both the Nasdaq and the S&P 500. Notably, the chipmaker's profits throughout that time have helped offset the sharp decline in stock that occurred in early 2025, when it said it would incur a $5.5 billion charge related to the export limitations of H20 chips to China. Although some analysts have increased their price estimates, others warn of persistent challenges brought on by the uncertainties surrounding future trade relations between the United States and China, as well as the possibility of more stringent restrictions. The data center segment's robust growth contributed to the third quarter report's excellent top and bottom lines. The company's decision to invest in U.S. AI infrastructure shows tenacity in the face of difficulties. Wall Street examines if Nvidia can maintain its recovery and spur additional growth as analysts look at the strong demand for data centers. Nvidia must contend with trade constraints between the United States and China, as well as high market expectations. The significant write-down mentioned above occurred in the first quarter due to export restrictions on its H20 AI chip, which was created especially to get around export limits on cutting-edge technology to China. Analysts estimated that the prohibition might cost the company $9 billion in lost sales. The first quarter's fiscal performance would be impacted by about $700 million, with the remaining $8 billion being distributed across the second and third quarters. As competition from Huawei's Ascend chips increases, supply chain costs were also threatened by U.S. tariffs and China's punitive actions, especially for components imported internationally. Analysts warned about margin pressure due to these issues. Nvidia's profitability is still strong, though. According to reports, the levies have caused the company to increase the price of some of its most well-liked GPUs by 10% to 15%. It raised the price of high-end AI GPUs by up to 15% and gaming processors by 5% to 10% to offset rising production costs and maintain steady profits. However, Nvidia's supply chains are strengthened by investments in U.S. AI infrastructure, which are backed by its $37.6 billion cash reserve and Taiwan Semiconductor Manufacturing's $165 billion Arizona fab expansion. During his recent visit to South Korea, CEO Hwang declared that Nvidia will provide over 260,000 GPUs to South Korean companies, such as Samsung and Hyundai Motor. According to him, AI has entered a virtuous cycle whereby advancements in the models generate more funding, which in turn spurs additional advancements and funding. He added that he hoped the U.S.-China trade negotiations will result in a policy shift that would enable Nvidia to start selling cutting-edge chips in China again. The business can now sell its cutting-edge H200 AI chips to China, thanks to the U.S. president. Grand View Research projects that the AI market will expand at a 37% compound annual growth rate, CAGR, through 2030. This validates Nvidia's projected revenue of $170 billion for the fiscal year 2026, which is 30% more than the $130.5 billion it made in 2025. Nvidia reported a record-breaking $57.01 billion in sales for the third quarter, of which $51.2 billion came from its data center division. Due in significant part to the intense demand for its AI processors, the total was up 66% year-over-year. In fiscal 2025, the chipmaker expanded Blackwell accelerator manufacturing and AI infrastructure by investing $3.2 billion in capital expenditures. To fulfill hyperscaler demand, the company's capital expenditures have increased by more than 200% this year, reaching over $3 billion. Even with the apparent thaw, there are still hazards associated with U.S.-China trade limitations. Tariffs could increase expenses, which would account for the reported price increases. Nvidia's adjusted operating income of $37.8 billion was offset by a 36% increase in R&D operating expenses to $5.8 billion. However, data centers are not the only factor contributing to Nvidia's rise. Thanks to alliances with Toyota and Aurora Innovation for autonomous vehicles, the company's automotive segment grew by 32% year-over-year to $592 million. In light of tariff uncertainty, this diversifies Nvidia's holdings. Nvidia's third-quarter fiscal revenue is expected to be $65 billion, give or take 2%. This outlook was better than what most analysts had predicted. For Nvidia shareholders, this year has been somewhat turbulent. In April, the stock fell to a 52-week low of $86.62. The share price rose following the first quarter results and an announced halt to U.S.-China tariffs. The company's market capitalization momentarily exceeded $5 trillion when it reached an all-time high of $200 in October. Analyst sentiment is still bullish despite some insiders dumping stock. 11 of the 60 analysts who urge purchasing shares, out of the 64 who cover the stock, have strong buy ratings. The consensus price prediction for the next year has risen to $250.93. That aim indicates a potential upside of almost 36% from the present price. The range of targets for each share is $140 to $352. Morgan Stanley, JP Morgan, Citigroup, and others recently kept their buy equivalent ratings. The street high target price is held by Evercore ISI. Strong demand for Blackwell chips, an improved supply chain, a sizable pipeline, and faster revenue growth were all mentioned. However, well-known investor Michael Burry has a negative opinion on Nvidia. Nvidia was well-positioned for success in 2025 thanks to its leadership in AI, 93% growth in data centers, and automotive alliances with Toyota. But care is needed due to tariff risks and DeepSeek's competitive AI algorithms. Nvidia's financial buffer and Stargate project role provide stability, while the rise of the AI market and the chipmaker's $47 billion second-quarter revenue position it to reach its $170 billion full-year revenue target. However, there are still issues with value. Growth-oriented investors should purchase Nvidia, but others should proceed with caution. Nvidia's year-end price objective of $230.16 per share, or a 26.1% gain, is set by Wall Street. This estimate takes into consideration anticipated Blackwell supply restrictions, DeepSeek competition, and tariff threats. It also takes into account Nvidia's dominance in AI and its revenue projections for the second quarter of 2026. It is the unquestioned heavyweight champion among processor manufacturers in the United States and the darling of the financial markets. In fact, Nvidia is highly regarded, and many traders believe it is unstoppable. Numerous price forecasts exist for Nvidia stock, and some bulls may easily see the share price reaching $500 by 2030. But is this too unrealistic? The skeptics could think $500 is an unattainable goal and question whether the rally is sustainable. However, as the information will show, Nvidia is a dominant force in the chip industry in the era of artificial intelligence, AI. Therefore, keep an open mind because there is a significant upward potential for Nvidia stock. Despite being a market favorite, Nvidia has its detractors. Michael Burry, the hedge fund manager featured in the movie The Big Short, is one commentator with a pessimistic outlook. Burry likened Nvidia to Cisco Systems, the massive telecom hardware company that collapsed with the dot-com bust, as Rich Dupre discussed here and here. It seemed as though Cisco and its stock would keep rising in value indefinitely in the late 1990s. According to Burry, Nvidia's market value will likely decline in the upcoming years, just like Cisco's did following the late 1990s. By holding put options, his business, Cyan Asset Management, has even gone so far as to adopt an extremely pessimistic stance against Nvidia stock. If Burry's analogy between Nvidia and Cisco is accurate, it seems improbable that Nvidia's stock will hit $500 by 2030. In retrospect, the excitement surrounding Cisco was greater than the real need for the company's goods. So, is there a lack of demand for the AI-enabled chips from Nvidia? Financially speaking, it appears that there is sufficient demand for AI chips to keep Nvidia afloat. This should be evident from a cursory look at Nvidia's third quarter 2025 numbers. Nvidia made $57,006 billion in Q3 2025, up from $35.82 billion in the same quarter the previous year. This represents a 62.5% increase, with Nvidia's data center business accounting for the majority of the company's $51.215 billion in third quarter 2025 revenue. Therefore, there is a high demand for Nvidia's AI-compatible devices. Additionally, Nvidia's net income increased from $19.309 billion to $31.91 billion, a 65.3% year-over-year increase. To put it another way, the business is making a lot more money than it is spending. Nvidia CEO Jensen Huang declared that the company's cloud GPUs are sold out and that sales of its Blackwell chips are off the charts for the future. As a result, Nvidia doesn't seem to be in the same vulnerable situation as Cisco was in 1999 in 2025. The doubters may contend that Nvidia is incapable of increasing its sales significantly beyond what it now does. A recent trade deal between the United States and China, however, suggests that Nvidia might have fresh ground to explore. President Donald Trump is permitting Nvidia to sell its H200 AI chips to China, according to the Wall Street Journal. The journal claims that Trump stipulated that Washington would receive a quarter of Nvidia's Chinese revenues. If everything goes as planned, Nvidia will benefit greatly. According to the journal, the company calculated that if there were no geopolitical restrictions, it could transport up to $5 billion in orders to China per quarter. The ramifications extend beyond potential short-term income. It is clearly undeniable that the present government respects Nvidia and works to safeguard its interests. It's unclear if the incoming presidential government would treat Nvidia with the same business-friendly attitude. However, it is likely that the current administration will remain in office until January 2029, which is good news for Nvidia and its investors. Investors should anticipate that Nvidia's market capitalization will increase over the next 5 years, given the rate of development in the company's sales and revenue. The path of least resistance for Nvidia stock is upward, unless it truly crashes like Cisco once did. Indeed, over the past year, Nvidia's stock has already increased by 33%. However, the company's net sales and revenue increased by 62.5% and 65.3% respectively, year over year. Furthermore, those growth numbers are from a period before the president approved the sale of chips to China. Therefore, Nvidia still has the opportunity to broaden its sales base and eventually its economic base. Overall, the likelihood of Barry's disastrous AI chip industry collapse seems remote. The chances were in favor of the shareholders due to the financial information and the government's seeming desire to safeguard Nvidia's interests. As a result, Nvidia's growth trajectory should continue until 2030, and it seems evident, though not assured, that the company's stock will reach $500. For this reason, it makes sense to hold a small number of Nvidia shares over time, but not too many. Nvidia is once again at the nexus of market momentum and geopolitics, and investors may find that the company's most recent export guidance sets the tone for future developments. On December 8th, U.S. President Donald Trump decided to let H200 shipments to authorized clients in China, providing Washington with a selective openness as China works to expedite its AI infrastructure. Reversing what was formerly a complete export restriction, the action may be seen as a calculated move that protects the most sensitive technologies while granting China limited access to cutting-edge computing power. The H200 is still the most sophisticated iteration of Nvidia's Hopper architecture, which debuted in 2022 and quickly rose to prominence as the foundation of AI computing in large data centers across the globe. It began widespread use in 2024 and continues to handle a substantial portion of AI workloads worldwide. Additionally, Nvidia created the H20 as a limited substitute for China, adhering to long-standing U.S. specification restrictions under both Joe Biden and Trump. The H20 performs far worse than the H200, and the U.S. eventually removed its export ban following a changing regulatory cycle. In response, Beijing instructed local businesses to steer clear of the H20 and give preference to domestic alternatives. This prompted Nvidia to openly admit that it does not currently have any orders related to China's massive data center industry. In August, Jensen Huang calculated the potential value of the 2025 opportunity inside China to be as high as $50 billion. Investors are keeping a closer eye on the Blackwell architecture because, should export dynamics ever change, there is where the largest commercial opportunity could be found. Following its debut in March, the B200 flagship went on sale in late 2024. Nvidia reported $51.2 billion in data center revenue in its most recent quarter, a 66% rise from the same period previous year and more than the combined yearly sales of Intel and AMD, thanks to the unprecedented demand. Trump earlier stated that he would eventually think about a scaled-down B200 for China, but he made it clear that Blackwell chips are not included in this arrangement when he approved H200 exports. In order to maintain Nvidia's technological lead and strengthen Washington's control over the most cutting-edge layer of global AI computing, the B200 is currently firmly off the table for Chinese purchasers. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.